All right, wonderful. Good morning, everyone. Thank you so much for taking time to join us today as a part of our webinar series. I'm so pleased to be sharing today's session with Wayne Thomas, our esteemed author and educator. Wayne is the interim dean of the John T. Steed School of Accounting at the University of Oklahoma, and we're so pleased to have you presenting today. Wayne, this is your stage. Take it away.
All right. Well, thank you. It's good to be with everyone today. And like we were saying at the outset, I hope everybody feels interactive today and feel free to chime in on the chat session. I've asked them to just jump in anytime that someone sends a chat with a question or even a comment for the group. I hope you'll feel comfortable that this doesn't have to be just a straight presentation, but more of an interactive session. So let's jump into today, talking about COVID-19 and just stopping to think about in just a very simple way, what is the response to COVID-19 been? And certainly we've seen consumer behavior changed, eliminated non-essential purchases. We see social distancing. We all are very aware of all of these changes. What have businesses done? They started shutting down even before government imposed disruptions. So we've seen that happen. We've seen the government impose restrictions. We've seen businesses stop doing some of the things they're doing because employees aren't available or supply chains are not available. And then we've seen the governments react with operational guidelines. And then the thing we're going to talk about a lot today is the CARES Act. And many other relief packages are coming along, and these are changing all of the time. And then to get into more about what we're here for today is how are regulators and accounting standard setters responding to COVID-19. So before starting out, something I like to do with my students and continually remind them, because I think we've all taught accounting, or most of us on the line are accounting instructors. Or if you're not, maybe this is your perception of accounting, that it's very mechanical, very internal, very narrowly focused in what it's trying to do. But really, accounting has a much broader goal, a much more important role. So we think about there's economic activity in our social system. The role of financial reporting is to capture that economic activities in a series of measurements and then communicate it through financial reporting and disclosure. Then people can begin to analyze that and make decisions. Decisions lead to outcome, and outcome impacts society. And that's the role of financial reporting in our society. And you think about this loop going over and over from economic activities all the way through financial reporting to outcomes, and then repeating itself continually. And why are we doing that? Because we're trying to achieve a greater social good. And this idea is what was captured by the Pathways Commission of the AAA and the AICPA, in that accounting is not just this self-contained, boring set of historical numbers, but accounting is full of opinions, judgments, discretion, forward-looking information that is absolutely essential to any thriving market-based economy. We have to produce good information because good information leads to good decisions. Good decisions lead to a more prosperous society. So I think that's the mindset that we need to think about accounting, and we need to convey what accounting is to our students. And this was expressed, in many, many different ways. This is one of 1,000 quotes, but if you think about what we do in financial reporting, it's not just for the sake of reporting. We want to be part of the solution. And right now, our society is facing a great challenge with COVID-19, and we see people are being part of the solutions. Lawmakers are being part of the solution through relief acts. Certainly, our scientists are part of the solution in coming up with an antivirus or other types of medicines to help ease the systems. Well, what can we as accountants do to be part of the solution? What can we contribute to our society? And what we can contribute is high quality financial information. And so this was recently a quote by the chief accountant at the SEC. So with this in mind, we stop and we think about what can we do in accounting to capture economic reality to keep our market-based system thriving forward. And this is what I want to continually stress with my students, no matter what subject we're teaching. So what we're going to go over today is the CARES Act, the Coronavirus Aid, Relief, and Economic Security Act. And we're going to talk about the different parts and how they are going to impact financial accounting. Because ultimately it's this, if financial reporting matters, all right, and if COVID-19 had an impact, then we should see COVID-19 impacting financial reporting. And if the relief package by the government matters to companies, then we should also see that reflected in financial reporting. So remember, financial reporting is telling a story of a company. And today's companies are telling a very interesting story, and that is the impact of COVID-19 and the subsequent impact of any government relief. All right, so these are the topics we're going to go through today. And I hope you'll feel really comfortable. So as you look at this, is there a particular question or thought you'll have in mind? And I'll try to slow down when we go through some of these topics. I want to be mindful that we don't have a lot of time together today, but I want to go through as many as I can. And of course, the deeper you look into anything, the more examples you could find. I also will go through some real company examples. And I think what's neat is, and let me go ahead and switch to this next slide. You're going to see that, and don't try to digest all of this, but as I was preparing for this slide, I thought, well, how many teaching opportunities, how many kind of interesting conceptual debates are there to go over today? And the fact is there's lots because of a dramatic change in the economy, which is going to impact financial reporting. We have lots of really interesting examples we can turn to. How does government tax relief impact financial reporting? Loans or grants from the government? What happens if a significant economic event happens to a company, but there is no specified GAAP? What do we do then? Do we do our best guess? Do we turn to IFRS? Are we going to really suspend GAAP and issue non-GAAP financial statements? And the answer is yeah, in some ways we are right now. How can accountants provide relief? We know how lawmakers can provide relief through taxes. How can accountants provide relief? Maybe delay in filings, defer the new standards, which takes lots of processing costs. So we're going to discuss different things like this. One thing, and I'll note this, think about this, the emphasis on forward-looking estimates. So maybe many of you have run into people with the concept, well, accounting is backwards looking. Well, there's certainly a part of accounting that's backwards looking, but a substantial part of accounting is forward looking. And when that forward looking estimates are in the face of the uncertainty we face now, we see just how much accounting can be impacted. All right, so we're going to go through many of these. And like I said, I'm going to bring up some real world examples today. And I searched for some to get ready for today's presentation, but it's almost back to this one with the delay in filing deadlines. Some that might have already appeared are not quite here yet, and we'll start to see some really interesting disclosures in the just few weeks ahead. All right, so let me jump into this first topic because I think this is probably where we're going to see the biggest impact of the CARES Act, and that's on net operating losses. So if you think about net operating losses, they're going to create a deferred tax. Now, starting with the Tax Cuts and Jobs Act of 2017, companies could no longer carry NOLs backwards. They could only carry them forward, and they could only carry them forward with an 80% amount. And so it did create a deferred tax asset, but it wasn't an immediate relief on taxes. It was a forward relief. All right. So this will also now, with the new bill, we can actually carry these back 5 years. So what was the old rule that was done away with the Tax Cuts and Jobs Act has been reinstated. And that, by the way, that's going to run over the previous years, but it had a bigger tax rate. So here's the reporting implication. we're going to have existing deferred tax assets due to net operating losses that could be converted to tax receivables. And these tax receivables could be greater than the existing DTAs. And it's the removal of this 80% limit that would reduce the valuation allowance, because now we can go backwards in time, which is a certain thing, whereas a valuation is an uncertain DTA. And also, though, there is a chance that the future uncertainty of economic conditions may actually increase the valuation allowance. So we've got a lot of deferred tax asset. And what I'm going to do is go through what I hope is a real simple example and give you an idea of the impact that this could have. So let's start up here. So think about a company who's got a taxable income over these particular 4-year spans. So in 2016, we had a $600 taxable income, then 400. 2018, it was down to zero. And then last year, 2019, they reported a $1,000 loss. All right. So what did they do in 2019? Well, under the Tax Cuts and Job Act, no carryback was allowed. So you couldn't take that $1,000 net operating loss and apply it to back years and get a refund. So what companies were doing in 2019 is they were recognizing a deferred tax asset. Let's use a 21% tax rate. So they put a $210 tax benefit on the books. All right. And so that's a deferred tax asset. And that's good because in future years, it's tax deductible. And all right, it'll reduce taxes in future years if they're profitable. So that's the way it happened. But now let's kind of add a little complexity to the situation. In 2019, perhaps the company, they're operating at a loss. You're allowed to recognize a deferred asset only if it's more likely than not it can be recovered. And if it won't, you must set up a valuation allowance. So let's suppose the company thinks approximately 40% of that may not be recovered. So they would have to establish an $84 valuation allowance. So we get down to what is the net DTA in 2019? It's $126. That initial 210 that we've deferred, future tax write-off, but an 84 valuation allowance that we expect that we won't recover. It's more likely than not we won't recover. All right, so we've got a $126 deferred tax asset on the books. Now, here's where the CARES Act comes in. In 2019, we are now allowed to carry back that $1,000 operating or taxable loss to prior years. So we'll take that back to 2016 and 2017 when the tax rate was 35%. And by the way, if you're going backwards, there's no longer any uncertainty. Remember that $84 uncertainty valuation allowance we set up? Well, if we're going to go backwards into years with profitable income, there is no need for a valuation allowance. So that $126 DTA that we set up in 2019, it's actually going to be converted into a $350 tax receivable. That $1,000 operating loss last year, because of the CARES Act, we can apply it to prior years when the tax rate was 35%. So 35% times $1,000 write-off is an immediate $350 tax receivable. So this is how the story of the CARES relief, the tax relief of the CARES Act, will be told through companies' financial statements. All right, and just as a quick example, and again, I pulled these very quickly. They're starting to pop up all over the place. I read in one place that we're already at $7 billion in tax relief that companies are reporting. Valero has a $110 million tax benefit, being able to carry back a net operating loss. And where are they carrying it back? They're going all the way back to 2015 when the tax rate was 35%. All right, and here's an example of Fitbit. And you can see at the end of last year that they had virtually no tax receivable. But by the end of the first quarter, they have a tax benefit of $145 million because of the CARES Act. And this is due to them carrying a net operating loss back into prior years with a 35% rate. So all of a sudden you have about $140 $1 million income tax receivable pop up on their first quarter balance sheet. So this, again, the thing I like to tell my students is financial accounting is storytelling, and we should see the story of COVID-19 in financial statements, and we should see the story of the CARES Act in the financial statements. So let me just kind of slow down there, and this is just one of many topics we'll talk about today. But this is how we're seeing government relief show up in financial statements at the moment. Are there any questions or comments at the moment? We've got plenty to go through today, so I'm happy just to kind of keep crunching through some more examples and thoughts for everybody, but happy to take questions or comments.
Hi, we do have one question coming in. Someone just simply asked, they're curious about the journal entries for recording during this pandemic. Do you have any insight or expansion on that topic?
Yeah, for example, the deferred tax allowance, you would take that off. So you take your deferred tax asset for whatever amount it would be, and you're going to take the deferred tax asset, and you'll take the debit, and you'll credit it, and you'll take your deferred tax allowance and debit it, and then you'll have your income tax receivable for the difference. Or, eventually it'll be a debit to cash for the tax refund amount.
Wonderful. Thank you, Wayne. And we're also getting a number of questions in regards to if you would be willing to make your slides available to our audience after this event.
Yes, absolutely. I meant to say that at the start. So happy to do that. And that I've got some details on these slides, and I don't know how much of this we'll all get through. But I wanted to keep the detail because I wanted to be able to send these to whoever wanted them. So happy to do so.
Thank you, Wayne. Go ahead.
All right. So again, chime in, and they'll jump in with more questions. Okay, and this one's going to work very similarly to the net operating loss. It won't have the significant impact that the net operating losses do, but it works the same. And so again, lawmakers were thinking, how do we get cash in companies' hands immediately? And the way to do it was take a net operating loss and go backwards instead of forwards, because forwards is a future tax benefit. Backwards can be an immediate tax benefit. So the same idea was applied here. So if we look at interest expense, it's deductible up to 30% of taxable income. What the CARES Act did was jump it up to 50%. And you can even go back to 2019 and apply. You don't have to just do it for the current year. And presumably 2019 is going to be a better year for most companies than 2020. So we're going to get a bigger tax deduction. So companies can actually go back to 2019 where it was 30% and apply the 50% and get an immediate tax refund. And so there again, we're going to see DTAs, tax refunds, valuation allowances being able to go backwards. We're going to see all of those affected in the same way to represent the immediate tax relief provided by the CARES Act. Now, here's another interesting tax relief package in the CARES Act. Again, it'll affect most companies, not quite all, but most. And that is to defer the employer payroll taxes. So employers right now pay 6.2% of Social Security tax on behalf of their employees. Beginning with the date of the act, which was near the end of March, through the end of the year, that 6.2% does not have to be paid. Instead, through the end of 2020, you'll take all of those 6.2% that you owe, and you'll make two installment payments, half of it by the end of the next year and the other half even further out. So you can see it takes an immediate cash payment for Social Security taxes, and it delays it for a significant amount of time. And then on top of that, what they're doing is they're taking employee wages up to $10,000 per employee per quarter, and they're giving you a 50% tax credit. So that tax credit can be applied immediately. So you think about this, even if you have a worker who's not working, if you pay them up to $10,000, $5,000 of that is a tax credit. So again, the idea was that the the government wanted to keep people employed. They wanted to give companies a tax break. And so they established this employer payroll tax relief portion of the CARES Act. And by the way, we're going to apply this credit to any Social Security. And if it's greater, then we get the immediate tax refund. So what is that? It's the typical, we're still going to accrue a payroll tax expense, the 6.2%. So that would be our journal entry. We would debit that. But instead of crediting cash, say for our payroll tax to be paid in, we're going to credit, instead of crediting cash, we're going to get a credit salaries payable or security tax, FICA tax payable. And again, that's going to create a deferred tax asset. And the tax credit will be recognized as a government grant, which again, we can think about that as an expense offset or other income. And we're going to talk in just a minute more about government grants, because that's going to end up being a significant part of the CARES Act.
Hey, Wayne.
Yes.
This is Becky. Before you move on, just a couple of questions that have come in. One attendee asked, how would PPP forgivable loans show up in financial statements since they are forgivable?
Okay.
Looks like you're right about to talk about that.
Becky, that could not have been better timing. So, yes. So this is where I think we can get into some the neat thing, two things I think about this. These are where you can really get into some interesting concepts with students. When you stop and ask students, how would you do this? Here's something that's really going on. What would you debit? What would you credit? And, and it's not that there's a right answer. It's a gray area. And that was that opening chart that the Pathways Commission developed. And remember, the whole idea of the Pathways Commission and this role of accounting leading to a more prosperous society was to elevate the importance of financial accounting, financial reporting to people, to students in particular, to draw the very best and the brightest. In that accounting is not just a mathematical game, it is really a judgment data science that leads to improved decisions and ultimately an improved society. So this is an example, the Paycheck Protection Plan. So the idea was Small Business Administration would grant up to 10 million maximum. It's a personal guarantee. The personal guarantee, the collateral requirements, and the borrower fees are all waived. All right. Principal and interest. Now, here's what Becky was just asking about. Principal and interest are forgiven if the funds are used for payroll and other eligible payments. The other eligible payments you could think about like rent or mortgage. Now, the max of those other payments were 25%. So really the bulk of this is intended to go to payroll. And companies are going to be audited to make sure that they're doing it the right way, except that if you receive less than 2 million, it's going to be presumed that you're using it the right way, because it's just too difficult to audit all of the smaller companies. And so is that a loan or a grant? And so this is the questions we pose to our students. And by the way, when I say our students, it's not even clear at the moment to some accountants what this is and how it's going to be accounted for. So we're going to see some guidance very soon. If initially a loan, when does it turn into a grant? So I get the money today, I debit cash. What do I credit? And probably the way this is going to start out is we're going to record this as a loan, and then systematically and rationally over its life, we're going to recognize it as a grant. Because if I retain my employees and do the things that the Paycheck Protection Plan requires, then it is a forgivable loan. But on day one, I have not met the obligations of the funds, so we'll probably end up counting that as a loan initially. But we're in new territory. There is no clear guidance. Okay. And so how do you rationally recognize going from a debt to a loan, to a grant? Well, we're probably going to end up doing some type of deferred income, so a liability. And then as it is recognized, we will match that grant with the expense, like salaries expense. We'll match it in the income statement, either as like on a gross method, we'll have salaries expense and then other income as we recognize the loan going from a grant, or we could just net the two and have a smaller salaries expense. So again, more guidance to come because there is no clear guidance in the literature at the moment. So I'm going to pause right there because Becky brought that question up. And this is going to be, of course, a big part of the package, at least for smaller companies. And just an interesting thing, a lot of the bigger companies were getting this when they weren't supposed to. So as you can imagine, trillions of dollars going out of the treasury in a very, very short time frame, it was impossible to get everything right. So, and even some lawmakers are, like with the net operating losses we went over, some of the lawmakers are now saying, wait, that was too much. And so they're starting to be a little backtrack even on that.
Wayne, we did have a question coming in asking if you can apply the tax credit in addition to receiving a PPP loan.
Are they referring to this prior slide? I'm guessing.
Yes.
Interesting. If you get the PPP loan, then you do not qualify for the payroll tax relief. So again, these are, you can really start getting into the weeds on this, but this payroll tax relief was meant for companies that were not getting the payroll protection loan, paycheck protection plan, because these are intended to be grants. The government has every intention for companies taking this money, using it for employees, and keeping the money, or not keeping it, but not paying it back.
Thank you, Wayne. We also had a question come in, and this is in reference to your Fitbit example. The question is asking, would the difference be recognized as a gain? And some further explanation. Our attendee says, I know that we'd remove the recognized DTA and valuation allowance and recognize the tax receivable, but they're wondering what account should be used for the difference.
So in that particular case, you would have a corresponding let's see. So Fitbit, I'm trying to figure out exactly what part they're asking. And I'm not exactly sure. Sorry, I'm not clear on exactly what portion of the question they're asking.
No worries. Po Chang, if you want to give us a little bit more feedback in the chat, we can come back to this question.
Yes, I'd like to.
We do have one more question coming in, and it is that the CARES Act did not mention 75% to wages. The SBA inserted that rule only after PPP loan applications had started coming in. The SBA can still change these rules. Any thoughts around that?
Okay. So read the first part of that question again. I actually had my thought on the other one. Now I understand the question. Go ahead.
The CARES Act did not mention 75% to wages. The SBA inserted that rule only after PPP loan applications had started coming in.
Yes. And that's why I was saying this is continually evolving, but that's right. So the SBA wanted 25%. That is correct. So I agree completely. But to answer the other question, yes, there would be the offsetting gain because, and that's kind of the interesting part of the NOL carrybacks is because you're going to have an asset, either the receivable or the cash, bigger than the asset that was currently on the books with the DTA, the net DTA, and it could be considerably bigger like we're starting to see. Yeah, and then that gain will run through the income statement and ultimately be in retained earnings.
Thanks so much, Wayne.
Yeah, sorry I didn't understand that initially. So, Again, this is to me another interesting aspect of it is, and these are not these are loans, so these are not intended to be grants like we just went over with the Paycheck Protection Plan. These are 1% loans, and they're industry specific. So these ones in particular, we're going to passenger airlines and related businesses critical to national security. You must show evidence of losses related to COVID-19 and that you could not obtain funds otherwise. So again, the government wanting to give emergency relief in case banks were too scared to lend to, in particular, passenger airlines. But there are restrictions. And again, this is a political thing. And you think about if you've been watching the news, these companies receiving these loans could no longer make dividend payments. Airline companies have been hugely repurchasing their shares. And that's so that, people, when they're in crisis, people have said, well, sure, you're short of cash because you've been giving it all back to your investors instead of saving it for, a crisis. But you must retain your existing employees to the extent possible, no less than a 10% reduction. And this is the interesting part. You're going to issue stock warrants to the U.S. Treasury. All right. So what's going to happen? Well, that's still also a little unclear. And these are massive loans that are going to companies. And there's no specific guidance currently under GAAP on how to do it. We do know that the loans are the 1% loans do not require imputed interest because there's this kind of exception in the code that says when you get these low rate loans from a government entity, then you don't have to impute the interest. And then the stock warrants will have a dilutive effect. So let me go over one more quick example, and then I'm going to jump into a financial statement. So related to this, we also have grants to targeted industry. So again, let me group this previous slide on the loan program with government grants, because in addition to the quick loans to the aviation industry, the government also set up grants to target it. And again, grants are, you can think of it just like a grant. It is money that does not have to be paid back. And again, more to the aviation industry, but also healthcare, education. Again, we see no specific guidance under US GAAP. So there needs to be some guidance coming forward. But I also think these are interesting issues that are not straightforward that we can bring up with our student to show them the judgment in financial reporting. Possibly accounted for as revenue. So think about this. If the government is giving you a grant because you provided health care free to many individuals during COVID-19, essentially they are paying for the customers. So some companies may consider their grants reimbursement for services to customers. So they would treat that as revenue under the new revenue recognition standard. However, most companies are going to recognize these grants as deferred income. This is what we talked about a little bit earlier. So I'm going to debit the cash when it comes in and credit deferred income, a liability account. And then over time, as I begin to do what the grant requires me to do, I can fulfill that liability and begin to recognize it in either other income or netted with related expenses. And so here's an example of what just happened with American Airlines. They received $5.8 billion from the government, and what that represents is a $4.1 billion grant. And again, that's a lot of money coming in, and there is no clear guidance at the moment on how they're going to account for it. 1.7 billion is a loan at 1% for the first 5 years. It jumps to 2% with a small adjustment thereafter. Interest is payable in March and September. If I remember right, the due date is the loan matures in 10 years. So again, here you see the government infusing a massive amount of money, and this is happening. I think 10 of the 12 airlines at last count, 10 of the 12 airlines were going to take advantage of this program. And then also what American Airlines is going to do is issue stock warrants to the Treasury. So they're going to give the Treasury 13.7 million shares warrants worth 13.7 million shares of common stock with an exercise price of 12.51. That is payment to the U.S. government, essentially, for the grant and the loan. All right, and what does American Airlines agree to do? That they will use those funds exclusively for employee wages, salaries, benefits. They cannot do involuntary furloughs, all right, through September of 2020. Again, keeping people on the payroll. They must maintain a certain level of service. They cannot purchase their own stock, and they cannot pay dividends. So even things like this could get into certain contracts affecting accounting. So we're just talking about kind of the first order effects and how this is going to be captured in companies' financial statements. And by the way, what we're doing here is also we're developing a very rich set of material for our classes. Our students want to feel like they're studying something that's real. And so COVID-19 is real. The effects are dramatic. So when we bring up company examples in class, they don't, sometimes they're little minor details, and it's hard to even see the effect on financial statements. What COVID-19 does is massively disrupted companies. You're going to be able to pull up, for example, I was looking at Darden Restaurants the other day, and the fall in they show the weekly, you can look up in their 8Ks, you can look at their weekly revenue. And their weekly revenue from their restaurants, how much it has fallen in this particular week versus the same week a year ago. But guess where it's up in revenue? I'll pause for the dramatic. It's up in takeout business, right? Because we're all going takeout now. So they keep track of their in-restaurant business as well as their takeout business. So takeout business is on the rise. Of course, it's a small fraction of their total revenue. But things like this, we see the story being told through financial accounting. All right, let me pause there. We have just a little bit of time left, and I want to get through just a little bit more. And I knew we'd run out of time, but any questions at the moment?
Hi, Wayne. I do have one question for you, and this is more of an overarching question. But what do you think companies are going to do to adjust for their loss of revenue? So examples being layoffs, furloughs, no new hires, pay cuts. What impact does it have from an accounting perspective, even though the relief funds were given out?
Yeah, I think we're going to, for example, and I started to put this in my slides knowing that I had too much, but for example, restructuring charges. So part of severance packages that you have with significant layoffs. So we'll begin to see more restructuring charges and special items in our income statement. So things like this, we're going to see the story showing up in financial statements. So we can look at particular industries that are heavily laid off, and we'll see that show up as restructuring charges. So I think certainly that's what we're going to see. When there's uncertainty, then capital quits flowing. And going back to the original point of our talk today and financial reporting and how to, get our students excited about what they're studying is we have to do our part as financial accountants to decrease uncertainty. Now, a pandemic is uncertain by nature. What can we do in our small realm to help reduce that uncertainty to continue the flow of capital and a more prosperous society? We can do the best we can at providing high quality information, but it's not easy, and it takes professional judgment, and there's gray areas, and that's what we do as accountants is we figure out and we circle back and we make mistakes and we redo it until we feel like we're getting it right. But it's a never ending model of professional judgment. And that's more exciting to students than let's total this column of numbers over and over and over. That's not a challenge, right? The challenge is taking uncertainty and trying to make it as certain as possible. Let me go through just a few more items, and I can go through these like GAAP deferrals. CECL was intended to come online this year. they are not going to recognize CECL. So I want to get to the punchline of this. Number one, CECL can be deferred. And the idea is that it may have taken lots of extra effort for companies to implement it. There's other emergencies at the moment. So accounting standard setters are trying to do accounting relief and not require you to implement a very complex standard today. But I want to point you down to the bottom here. I think one reason we're seeing a delay in CECL is it was going to result in more losses. And one lesson we learned from the financial crisis is when accounting creates losses based on fair value, there can be this kind of catapulting effect. A loss makes a company look worse, so it goes down. So it needs to record a fair value loss, so it looks worse and it goes down. And you see that over and over, and we're trying to avoid losses on financial statements in the moment so we don't perpetuate the financial crisis that we're in right now. And the same is going to be for troubled debt restructuring. So GAAP requires you, if you have troubled debt, to restructure it and recognize a loss. But we're going to suspend that at the moment so we can avoid more loss recognition. So those are the punchlines on those. So again, accountants doing their part in the middle of this pandemic. Now, just in the couple of minutes we have left, and I'll be very respectful of your time, I think we're going to see massive impairments to our assets. And what do you do with assets? You test for impairment, typically in the order that I show there. There's going to be some incredible examples of companies taking huge impairment losses, which are going to be devastating to the company and its employees, its suppliers, and so on. But what I want to emphasize is this: impairments are a way that it shows that accounting cares about the future. We're not just historical. We make our best guess of the future. We are forward-looking in our financial statements, even though they're called historical financial statements. They're forward-looking in many ways, and impairments are a great example. And companies are seeing major disruptions to their revenue streams, but the uncertainty in it. How do you forecast selling prices, future revenues, undiscounted cash flows? What discount rate do you use? And has that rate gone significantly up in the level of this uncertainty? So we're seeing cash flows go down, discount rates go up. That's going to magnify the impairment losses. Look at Wynn Resorts. Certainly, they've actually saved money on operating expenses because they're not operating, but their provision for bad debts are jumping up. So let me just go through these very quickly. We can think about inventory. Its net realizable value or market value are going to substantially decline. Here we see Valero. 3 months ago, there was no valuation allowance for inventory falling below its costs. Now we see 2.5 billion on Valero's books because of the tumbling oil prices in the last 3 months, in the 3 months ending March 31. American Airlines, again, a huge impairment because of its fleet. Why did its fleet get impaired? As a result of the decline in demand for travel to COVID-19. And I could have gone and found as many examples. And again, in a few more weeks, we're just going to have more examples than we could ever use in a class about massive impairment losses. Revenue recognition, about the question that was just asked, every step of the revenue recognition process is potentially affected. I think potentially, especially variable consideration. Think about companies no longer providing services due to employee availability, supply chain disruptions, operating restrictions. Remember those performance bonus? If you're a consulting firm and your client sales grow by a certain percentage, well, that's variable consideration. Well, what is the chance their sales are going to grow now because of the pandemic? So that performance bonus you were booking in over time in revenue may no longer happen. What about health clubs that have annual memberships that they were recognizing revenue over time? You may have to extend those because the health clubs were closed, and we still don't know the end of the pandemic. And the longer this lasts, everything that I've talked about today will just get in magnitudes greater in showing up in the financial story that we tell in our financial statement. So There's lots. I know we're at the end time. I'm going to kind of pause there and just say we know a lot's coming. We're going to see massive disclosures affecting companies. So I'll leave with this thought or answer any last questions. We have an opportunity as financial accountants to tell the best story we can for companies, to play our part in the pandemic. I think you're easily going to see numbers in financial statements that are clearly relatable to our students. So using these examples makes what we do in class seem real. And I think that's one of the best places we can get to when we're standing up in front of class and we're going over impairment losses of airlines, and students understand exactly what that means. So that was a lot for today. I get a little excited sometimes about what I'm talking about and make too many slides, but I wanted to share a lot with you. And like I said, I know I'm going to share these slides with everybody, and I'm happy to do so. And I hope you'll feel comfortable following up with me at any time. I'd love to talk more about this with any of you. So I'll leave it there.
Thank you so much, Wayne. We are so incredibly appreciative of the time you've taken to curate this session for what is considered an incredible number of attendees who have joined. And we do have some follow-up questions coming in, which we will pose to you after the session. And just as parting words, we do want to take the opportunity to thank all of the educators who have joined us today. We hope you can all take a moment this weekend and appreciate your resilience and your agility and your perseverance in light of this pandemic and your teachings and supporting student learning this past term. We think you are all phenomenal, so thank you so much. And we will follow up with all of you, including the recording of this webinar and Wayne's amazing slide deck. So thank you for joining us today. Have a wonderful weekend, everyone.
Take care, everybody.